Views expressed are solely those of the speakers and do not represent this show or its team.
It's never too soon to start getting out of the business, getting that dependency removed. To start looking at ways that you can do that. Ask yourself, what are things that I could get someone else to do, and withdraw yourself from that part of the business.
Good answer. I like that. Welcome to Built to Last, conversations on wealth, work, and life, where we focus on building businesses, wealth, and legacies that last. I'm Wade Lopez. I've spent 3 decades helping entrepreneurs, business owners, and families navigating how to build and how ultimately to transition what they've created. Today's conversation is going to be about business owners and what they should actually be thinking about with their own business and making those decisions that might feel right in the moment, but ultimately could limit their value, their cash flow, and even their long-term outcomes. So we're going to talk about why it matters, because most owners and their businesses are their largest assets, yet oftentimes they're not strategically managed. So I have with me today Todd Williams. Welcome, Todd. Todd is the president of Concord Business and Tax Advisors, and he works directly with business owners on strategy, tax planning, valuation, and we're going to talk about why these decisions and how they show up in the real world. So Todd, let's start here. What does it actually mean to treat your business like an asset rather than just something that you own?
Yeah, I think that's a good starting point for that conversation, because most people who are business owners, they may look at an investment portfolio when they're working with their investment advisor, and they're paying attention to what the rate of returns are that they're receiving from those investments. They're worried about the risk that they're exposed to. They'll sit down and talk with an investment advisor about how much risk they're willing to take on or shift away. Yep. But then they go into their business, and although it is probably the biggest asset in their portfolio, they don't look at it the same way. They're not looking at it based on what's the rate of return that I'm getting, how much risk am I exposing myself to, where could I take risk off the table. They're looking at it more like almost like just a paycheck, a job. They're going in every day and working, and that's how they're managing the business. Is just.
Why do you think business owners do that, though?
Well, I think it becomes a matter of, unfortunately, most of them are doing this where they're living it like a paycheck. And I think it's because, it reminds me of that old Dunkin' Donuts commercial where the guy's getting up out of bed at 4 a.m. I got to go make the donuts, right? So they're just showing up to make the widgets or the donuts every day, and they're grinding through the day, and they're making sure the bills are getting paid, the employees are getting their paychecks, and then whatever's left at the end of the day is what they're taking home as their paycheck. Right. And they're kind of just seeing it as that job, grinding through the day every day. And they're not taking the time to step away from the job, kind of get out of working in the business and work on the business, and see it as the investment that it is, and make decisions that impact the growth of the company versus just getting the job done every day, getting those donuts made every day.
But don't you think a lot of that has to do with emotion versus real aptitude inside the business?
Oh, absolutely. Emotion drives the decisions a lot by business owners. Right. This becomes their legacy, and they're working hard every day to provide for their family, make sure the bills are paid, make sure they have money in their bank account to pay their bills. And that emotional stress of just making sure that's done every day influences them.
With that emotion, explain why, in your opinion, it's hard. And I think most all in businesses that we first work with, even together, the first discussion is putting capital back into their business. Explain why that's important.
Yeah. So, putting capital back, I could see it as an example of, let's just assume someone's paying themselves a reasonable salary to begin with. That's a topic we could discuss later. But at the end of the day, after they paid themselves a salary, they get to the end of the year and they've made a profit, $200,000 or $300,000. Yep. And what we're seeing from business owners is they just draw that money out. They leave enough in to pay the bills for the next month or two, and they're drawing the rest out, seeing that as, well, I made this much money. And they're not thinking about, if I were to reinvest this back in as capital, where could I grow? Where's my best rate of return? Is it better to draw it out and it might be you're taking risk off the table. You're taking that money and you're putting it in some other investment, but they're not really going through the process of thinking about that and looking at, I could also buy new equipment, or I could, expand my workforce and grow my capacity, and what's the rate of returns I would have there if I would make those decisions instead.
So let's talk about something I think most owners misunderstand. We run across people that think they're ready to sell their business, right? And they think it's ready. They think it's time. Let's talk a little bit about why most business owners think they're ready to sell, but they're not really ready to sell.
Yeah. Well, I think the number one reason is they misunderstand the value of the business.
Right.
And so they miss that. And so they think their business is worth a certain amount and they're ready to exit and sell. And what they find out is that that's not the true value.
Why do they overvalue their business?
Yeah. So most of the time it's that emotional thing that you just mentioned a few minutes ago.
Yep.
Business owners tend to put a lot of emotion into the value of their business. They've worked long hours. They have the whole life history of the times they couldn't cover payroll and they had to stretch it and do whatever. Right. And this has become their legacy. And so when they start thinking about what the company's worth, they're thinking at it from their emotional standpoint. They're not thinking at it from the practical standpoint.
We use the term it's our baby, right? And we don't say that lightly, and we understand when other business owners say that. But the one problem I have communicating with a lot of them is they don't really understand what buyers are looking for sometimes. So let's talk a bit like from a buyer's perspective, and on the other side of the table, what are buyers looking for from a business when they walk in?
Yeah. So, really, you could boil it down to one thing. They're looking for transferable cash flow.
Right.
They want cash flow that is going to transfer over under new ownership. Yep. And in order to do that, they know, well, number one, they're just going to look at the financials and is it cash flowing? And then they're going to take deeper dives into that, do they have processes in place? Do they have systems in place? How much is the business relying on the owner to produce that cash flow? Because the more the owner is involved producing the cash flow, the greater risk to the buyer. Yep. Because maybe those skills don't transfer over, maybe those abilities don't transfer over, and so then cash flow doesn't transfer over.
And there's another hidden risk. Let's talk about dependency on the owner with the business, right? So let's talk about why it's best to build a business maybe that's not so dependent on an owner. Would you touch on that?
Right. So, that really gets into, I'm sure people have heard of intangible value and intangible assets. And those are the things you can't touch or feel. When we're looking at buying a business, you can go in and you can see the equipment that they have and the manufacturing line, or you can look at the goods that are being shipped out. But what you can't see is, what is the processes that make all of that happen? Are those documented? Is everyone following them? Or is it all in the owner's head? And he knows how they estimate that price, but no one else knows how they estimated that price. And when you start building around owner dependencies, that's very hard to transfer. You can't transfer that to the next person in a smooth transition. You want to be able to transfer your business and not miss a beat. And the new owners just come in and they're able to do it. And when everything's dependent on you, when you're the owner and you're producing the hours of work or the knowledge of how something's done, and you're not sharing that or creating a system, then it's very hard to transfer.
It is. And it's, that's sometimes when that discussion happens, we tend to hurt people's feelings because it's frank, right? And that emotion is there with them. But I think it also says the fact that, when people understand that a business is only worth what someone else can operate with it when they're not there, I think their eyes kind of open to what we're talking about, right? And we see that, like, I've never heard that before. I've never looked at it. And we talk about, we use EOS, the Entrepreneurial Operating System, and that a lot of that has to deal with having written procedures and operations so that if a piece is missing, someone knows where to go. And I think that's a big piece of what that talks about. But let's transition into, where do you see business owners misusing debt the most?
Yeah, so that can be critical in a business, and where we see it most of the time that they're misusing it. There's kind of two prongs, because it's using it for the wrong things or structured incorrectly.
Right.
And so using it for the wrong things would be, things like using debt to cover payroll, using debt to catch you up on your vendor bills because you got behind. That's not really solving a problem. It's just pushing it down the road. And so that's a problem that we see.
It's not a strategy.
People. It's not a strategy. Right. It's just it's a short-term fix to a problem that exists within the business. And until you address the problem, it's going to keep surfacing. Now you just have debt that you're paying back it's just adding to the cash flow strain. On the other side of that is the wrong structure gets into you're using a short-term line of credit vehicle to buy equipment that should be a long-term debt service. Yeah. And so now you're tying up your short-term capital with a long-term investment. So
let's talk more about what smart, using it smart credit. What does that look like? Yeah.
So, I mean, debt can be one of the fastest ways to grow your business if you approach it correctly. And some of the things would be examples of, like, if you're going to acquire another business to fold into yours that already has a cash flow that's already going to be able to cover that debt service plus add cash flow to your business. Or you're going to buy a piece of equipment that's going to add capacity to you, or be able to take on jobs that you weren't able to do before. So that's adding cash flow and revenue.
Right.
Maybe you're going to hire a new salesperson and they're going to go out and generate 3 times, 4 times their cost in new sales. All of those are good uses of debt. Yep. Where the debt's the vehicle to be able to do those things. You might not have had the cash flow to just go out and do it on your own. So it gives you the vehicle to do it, and you've planned for it. You know what the return's going to be, and you made a wise decision to make that execution.
So discipline, and
and
using it as a tool.
Yes.
But also staying on line with what your vision and your goal is, right?
Correct.
So that's the important factor too. So where do you think a lot of people leave money on the table when it comes to we used to call it hidden assets, right?
Right.
But where do you think business owners are leaving money on the table right now?
I mean, I think they end up leaving money on the table just by lack of planning.
Yeah.
Because they're not
good answer.
Because they're not having the forethought to put in planning, they make decisions that end up either costing them money or they lose opportunities where they could have grown or had additional funds coming in. Yeah. And so I think that's
and part of that planning too, I think not completing the whole planning with a purpose ends up with a business owner just eating more taxes than they should. So touch on that. I know you don't I know that's what you do, but let's talk a little bit about that.
Yeah, absolutely. I mean, tax is definitely a dangerous area that you can cost yourself more than you need to. You always hear the saying, the 2 things that are certain are death and taxes, which that may be true, but how much in taxes you have control over. And if you plan correctly and you treat taxes as an ongoing part of your business, and you meet with your advisors on a regular basis to make good decisions, then you can really reduce the amount of tax. I mean, we want everyone to pay tax because that means you made money. Right. And we were encouraging all of our business owners to make money because that's going to drive your value. But let's mitigate the tax by planning and having it as part of your business planning, that you're thinking ahead, not waiting to the last minute. A lot, too many people show up at the end of the year. Yeah. And it's like, here's my tax stuff.
Well, we call that reactive.
Reactive.
Right? Let's talk about the proactive side.
Let's be proactive, right? Not wait to the end because it's the decision's made for you. Yeah. And also don't do things just for taxes. Right. We see that mistake a lot where people I'm going to buy equipment on December 30th because I don't want to pay a tax bill. And they didn't need the equipment. They didn't put any thought on the rate of return. Now they borrowed money. Yep. And later they're going to have that phantom income where they're paying back that debt and it's not an expense anymore. Right. And they're going to be paying tax on it. Yep. And so there's no planning in any of those things. And I think that's a big risk for businesses.
Speaking of planning, though, and we had this conversation earlier today with a mutual client. There's a lot of people out there that just April 15th, my taxes got to be filed. But explain why, when you're a business owner, you have these extensions that are allowable, and what that gives, what the opportunity is for us working with them, as part of being on their team when it comes to things like profit share and stuff, and why it's so important to, we understand you want to file on time, but if you want the most effective tax planning strategy, you might need to kick that can down the road a little bit so we have a greater, so just talk a little bit more about that.
Yeah, so I think that's you just mentioned profit sharing. That's a great example to use, because we close out the year and we're doing the tax return, and you have a decision where you do have the opportunity to contribute to a profit sharing, and it's one of the unique items that you can deduct. One of many
right.
that you can deduct in the new year on last year's tax return, right? And so we can wait and see and do the calculations, like this is how much it's going to save you. And if we're doing it on March 15th, we might tell the business owner, hey, you can make a $60,000 profit sharing contribution and it will save you $20,000 in taxes.
Right.
Well, there's still $60,000 that has to be paid into the profit sharing, and there's still a tax
check
bill.
Needs to be written.
Right, a check needs to be written, and there's still a tax bill, even though it's $20,000 less.
They might still owe, and they want to, exactly.
So exactly, and so what an extension does is it gives you time to pay it, because under that particular provision, the profit sharing has to be done before you file your tax return, including extension. So now we extend that return till September. Doesn't change any of the tax consequences, but it just bought you 6 months to fund that profit sharing contribution, and that's important to business owners.
Pay yourself first. Don't leave a tip on the table.
Exactly.
All right. It's hard for a lot of people who just, a lot of business owners want to knock it out. Right. Want a deadline here, and it's just sometimes there's a lot of thought, because profit share is just one of many options. There's qualified and things that can be, and there's still non-qualified things that can be done for business owners. So. How do you see structure and timing impacting outcomes for small business owners?
Structure and timing are huge to a small business owner. Structure, you're getting into what type of business you are, what type of entity.
You want to touch on some of those changes just in the past year, 2 years?
Yeah, I mean, so entity options would be, you could be a C, what's called a C corporation. You could be a S corporation, which is a pass-through entity. You could be a partnership, which is another pass-through entity. C corporations pay their own tax. It's like its own person, and it has its own tax, and that tax rate has been reduced to 21%. The problem with that is when you take money out of that form, you have to pay tax again. Right. And so that's where you've probably heard of the double taxation piece, and that's where it comes from. Well, on the pass-through entity side, the entity, the company doesn't pay tax. You do as an individual. Okay. And so that's going to pass, all the income passes through to you, and you pay tax. If some of the tax changes, they introduced the 20% deduction, where you get 20% off of the pass-through entity income as a kind of what I would call a phantom deduction. You don't spend any money. It's one of the rare deductions that you don't have to spend money to deduct something. Yep. You just get 20% off of that income. And so just deciding between that, am I going to be a pass-through entity or a C corporation, or am I going to be a sole proprietor? And a sole proprietor has to pay what's called self-employment tax. Right. So they've got an extra tax layer automatically. So just that structure matters, and just what the tax rates are going to be, what deductions are available to you, yep. All of those things.
We had Mac McSwain on here a couple months ago. Or time flies. Could have been yesterday. I don't remember. Anyway, Mac made a bold statement, and I personally agree with it. But he said that he believes that we're going to be in the lowest tax bracket that we're probably going to be in during our lifetime if we have any just continuing average income of what we're doing. Do you agree with that?
I do. I do agree with that.
It changes a lot of strategies, right? We used, growing up, 20 years ago, we used to say defer, right?
Right.
And I see that transition changing a little bit when we talk about things. Touch on that as plan aspect.
Yeah. So like you mentioned, the deferring of income used to be a big strategy, which was the thought was anything we can do to push income down the road to a time where we believe tax rates might be lower would be a better benefit. And with the current situation that we all believe, Mac and I both would agree that we're probably at that lowest right now, so we're going to see tax rates increasing over in the future years. So you really got to weigh that. Like, is deferring the income today really the best decision? Because sometimes it's better to go ahead and bite the bullet and pay the tax now, and then let that money grow in the market. And I just recently was advising a client on that very thing, trying to decide, do I dissolve this entity and take out all of the assets and income today and pay the tax, which would be a big tax bite today? Or do I just let it sit in there and we deal with it later? And, the math is saying it probably makes more sense today. Go ahead and bite the bullet today and then let it grow outside of the entity, and the returns you get there will make up for the tax you paid.
I think a lot of people forget the tax profession has been just in an upheaval since COVID. We know that in our partnership, right? And so far this year has been one of the best years because, to me, tax isn't something you react to. Tax is something that you design. And our designs are really coming. It's really cool going to the clients. We finish things and go, hey, you owe $100 or you owe $300. I know a lot of clients like, I got $10,000 back. We screwed up. That's not good, right? But when it's okay to owe. I just don't want them to owe a lot, and that's really happening this year. And that means, because we know for the first time in a long time what the tax laws are, right? And there's no change, and there's no, hey, you need to worry more about helping businesses get their loan for COVID. I mean, there's been the extension, and then Virginia with unfortunately the hurricane, and then snow, and the just constant extension or moving deadlines. So hopefully that nothing like that happens again. But this has been a really good year so far when it's come to the design and the planning structure that went in, that we knew how to plan, worked out. And I just like that part of it. It's really cool. It's been good for clients and business owners. So let's move on to the next part, which is, what actually makes a business durable in your point of view?
Well, I think a lot of business owners will make the mistake to think durability is about, the grind, getting in there and working the hours and just spending a bunch of time. And if you could make it long term, that's durable to them, right? But in reality, it's not. I think what's really durable is creating a business that doesn't need the owner. And if you have systems in place and processes, and you're doing your planning, and you have a vision of where you're taking your company, and you can spend your time working on the business, not in it. That's what is going to create a durable business and something that's going to last.
On that, what do you see when you see a business owner break? Typically, what's it because of?
When they break? Yeah. The easy answer is stress, right? It's stressful to be a business owner. And I think, getting up every day, and it's not just your family you're taking care of, it's your employees and their families. And so, stress gets there. But I think it's the lack of planning is what causes ultimately for a business to break.
It kind of boils down to that, right?
It does.
The stress is created by that.
The stress is created,
you mentioned durable. The ones that we find that are easy to take to market or get them to that point are the ones that understand that planning with a purpose, not just about taxes, but it's about where you want to be in your succession, right? Who is it going to be? Internal succession, outward succession? You want to go to market? Those types of things help eliminate stress. Also, the biggest struggle we see sometimes is trying to help business owners, I don't want to say remove their dependency, but get them to understand that, again, if someone can't operate this business without you, it's not as profitable as you think it is. How do you help business owners with that?
Yeah. I mean, it's very much like the parent having their first child and leaving your child with a babysitter for the first time, because you think everything that needs to happen, right?
Well, you do.
Right. There's no one that knows more than the business owner about their business. Absolutely. But, I think that's one of those things that, when you can show them the impacts that it's having on the value of their business and how that is actually a negative to their business and that their value is going to decline, if they don't correct that, then I think that can help correct the course for them.
So I think what I heard is systems in place, right?
Yes.
And I think that having a vision and predictable cash flow.
Yeah.
Helps a lot, right?
Predictable cash flow helps a lot. Yeah.
Right now, one discussion we had in our last podcast, cash is king, it seems like, and it gives you opportunity to acquire other people that you're competing against too, right?
Right.
So what do you see from a kind of going back to a long-term thinking for business owners? What do you see just in your view from a tax perspective and things that they should be thinking about where we are economically today?
Developing your 5-year target, where you want to be 5 years from now, and understanding that what's going on today, the impacts that could have. Using debt that we just talked about wisely, to make sure you're using that as a tool.
Well, how often do you think someone should do a SWOT analysis?
So, we recommend when we're working with clients, we're doing SWOT analysis every other year.
Okay.
So we're doing it every other year. We want to do a SWOT analysis, and we want to do some surveys within the organization to assess where they're at, so that they can look for the opportunities to grow, is the big piece there, but also identify those weaknesses and threats and know for sure that they're mitigating that risk as much as possible.
And I think what we've identified here is a business that lasts is one that can operate without the owner. Right. Yeah. I think that's what we try to point out to the clients that we work with, that we're consulting with. Sometimes it's easy, sometimes not so easy. Right. Yeah. So, but I want to close out here. We've talked about a lot of things, but let's talk about what matters right now. If there's one thing that matters for a business owner today, what do you think that is?
Boiling it down to one is tough, but I would say the first thing would be that it's never too soon to start getting out of the business, getting that dependency removed. To start looking at ways that you can do that. Ask yourself, what are things that I could get someone else to do, and withdraw yourself from that part of the business.
Good answer.
So,
I like
immediate.
That. What about in the next 6 to 12 months? Like, what do you think a business owner, given the landscape that we're in today, right? I mean, there's a lot of things going on when it comes to energy cost. I don't think those things that's going to transform to where it was overnight. But it's good to be a producer instead of someone who needs it, like Australia and other places, right? But as a business owner, next 6 to 12 months, what do you think they need to be looking for?
The next 6 to 12 months, I think they need to have an understanding of their cash flows. And they need to be identifying areas where they can improve the cash flow efficiency, looking at their debt structure, and making sure they're using that in the correct way. And
we've seen a movement in debt. So what about using credit right now? Are you okay with it still, or do you think that's something you need to have a control of?
I mean, I definitely think you need to have a control of it, but I'm personally still good with using debt as long as it's. I am too. I think it's a reasonable rate still. So the last question is to close this out today: is what's the one thing you're watching over that you think a business owner needs to avoid right now? I think that they need to avoid willingness to just keep showing up every day and working in the job, because that's the easy default mechanism to go to. Just show up every day. Like we've been talking about, you're not planning. It's very easy. I mean, time flies. Like you just said, you don't know if you talked to Mac last month or 2 months ago, right?
I swear I don't.
It flies.
It's unfortunate.
It flies by, and you blink your eyes and it's been a year. And I think if you're not paying attention to that, you're going to get yourself in a spot.
Have a purpose.
You got to have
just show up. And sometimes I think that's really important. And I have to say, what some of my younger partners have taught me is you don't have to be there 12 hours a day to get a lot of stuff done. Todd, appreciate you being here. It was a great discussion. And for those of you listening, thanks for spending time with us today on Built to Last. If today's conversation helped bring clarity to your thinking around wealth, work, or life, that's exactly why we do this. Till next time, stay focused on building something that truly lasts.
This podcast is produced by Concord Wealth Partners, LLC, an investment advisor registered with the Securities and Exchange Commission. Registration does not imply a certain level of skill or training. The information presented is for educational and informational purposes only and should not be construed as personalized investment, financial, tax, or legal advice. Nothing discussed should be considered a solicitation or offer to buy or sell any security or investment product. All investing involves risk, including the potential loss of principal. Past performance is not a guarantee of future results. Individual results will vary based on personal financial circumstances, risk tolerance, and other factors. Concord Wealth Partners does not provide tax or accounting services. Tax and accounting services are offered through Concord Business and Tax Advisory, an affiliated CPA firm. For more information about Concord Wealth Partners, including our Form ADV Part 2A and Form CRS, please visit concordwealthpartners.com or contact us at 800-838-4370.